I had something very different in mind for you this morning until I saw this video. And this will be, of course, very different for me to providing this kind of content, but this is striking. You do not want to miss a minute. Now, maybe you've already seen the video. If you haven't seen the video, I would just want to encourage you, watch it to the very end. This is a great description of where the market is. This is a great description of where the economy is. This is a great description of how the transcripts, how the tariffs will or will not impact the economy. I'll be breaking in from time to time to give you some commentary as we go along. But again, I just suggest watch the whole thing. If you want to hit the like button now, I probably won't remember to suggest that later. Hit the like button, hit subscribe, hit notify. There will be at least more videos today because I have a lot of content lined up for you now. I guess I'm back from vacation. Okay, so this is Tom Lee. You know I'm a big fan of Tom Lee. Well, this is Tom Lee and a couple of others, all of whom seem to have clarity in a direction that I think is correct. So let's dive in.
What's up with this market? We tired? Have we run out of gas? What's the story?
I think the market's consolidating and maybe trying to get direction from what the market does, because we did gain 28% from the April lows. We got to digest that. Now we're in August, like the dog days of August, where liquidity is lower. And I think that we're still holding our breath because we're in a period where the Fed isn't going to make an interest rate decision until September. So some of the key macro is kind of on hold. So I think markets are wait and see, but I'd say that pullbacks have been shallow.
Is it fair to say there's a more sober view from investors about stocks? I mean, you've been suggesting that this is a hated V-shaped recovery, even as we continue to climb this wall of worry until most recently where we've sort of sputtered in place.
That's right. I mean, it's definitely the most hated. I can attest to it from our conversations with clients. We can see it measured in surveys like AAII, where there's stubborn bearishness net still. And then we did the rounds, Fundstrat did the rounds with a lot of our institutional clients the last 2 weeks. And I think folks are very cautious, which is actually good for stocks. They're cautious because, of course, markets have moved and our clients tend to be valuation sensitive. But I think adding to their frustration is that during that April downturn, many were selling their best names because they were trying to get defensive, and then they haven't fully reloaded yet. So I think that's why there's still room for stocks to go up.
So your clients are valuation sensitive, which makes me almost want to laugh, because is anybody valuation sensitive to what's been going on in the market?
So we have the situation where folks pulled back in April. We had a 20% decline, 21% on 21 plus percent on the NASDAQ. Folks didn't get back in to some of their favorite stocks, or not get back at least to the extent that they had been exposed. And so they're frustrated that they don't have all their cash in play. And that's happening in a situation where the S&P is at all-time highs. We have the NASDAQ at all-time highs. We have the Dow Jones Industrials lagging. And so we'll talk about breadth in a few minutes in this same video. But it's crazy out there that we are at 22 times PE. What Tom is going to explain is that it can go higher even so, and the rest of the people on the panel are going to agree with him. So let's continue.
Historically well above the averages on the prices that you're willing to pay for stocks.
Yes. I mean, what we usually tell our clients, but really at the core, any fundamental investor is going to use valuation as really one of their anchors, is that the stock market had 6 stress tests in the last 5 years, from COVID to the bullwhip supply chain, to the fastest inflation cycle in history, to the fastest Fed hikes in history, then to the Trump tariffs, and then, of course, U.S. bombing nuclear facilities of Iran. Those are things that could cause catastrophes for earnings, but instead the S&P earnings have actually grown. So I think we're in the process of re-rating the S&P. So I actually think multiples are continue drifting higher.
Okay.
So we're in the process of re-rating the S&P. Whoops.
And obviously,
something happened there. I'm sorry. So we're in the process of re-rating the S&P. So this question of being 22x or 22 PE, on the current valuations, even with massive, as we'll talk about in a minute, massive earnings results this quarter. Maybe it's nothing to worry about. Maybe we don't need to think about 22 as being a problem. And Tom will give you his reasons why he thinks that we could go higher than 22 and not be stretched. This is again absolutely leading edge in terms of thinking about this market, because it's uncharted territory. And so he calls it re-rating the S&P. Well, that would be completely new territory.
Yeah. They say there's too much speculation. You look at some of these stocks, meme stocks, low quality stocks, cult stocks, and other things that have gone up. These stocks. What's happening with some of this fervor that feels like it's in the market?
Well, I think the dearth of IPOs over the last 5 or 6 years has shrunk the number of stocks in the in the U.S. stock market. There's not even 5,000 listed stocks anymore. Yeah,
I'd give you 50 examples of other things that have just gone absolutely parabolic.
Yeah. Well, I think like a Circle is a good example of scarcity, because that was the best IPO really in 5 or 6 years, but it's a blue chip company. They are the biggest compliant issuer of stablecoins in the US, and it's growing prodigious.
So what you have is you have scarcity. There's not as many stocks in the stock market to even purchase. He'll talk about the fact the private market, he'll mention a brief mention that there's lots and lots of companies now that are in the private markets, but there's not even 5,000 stocks left in the total public market. And then we have new companies coming on like Circle, that is a scarce IPO. There's hardly any IPOs, but yet the kind of IPOs that we're getting are so fundamentally strong that they get crazy results when they come on board. So lots and lots of cash chasing not as many stocks.
So in a way, it makes sense that it went from, a $20 IPO to 200 today, because it's scarce. It's just as scarce as a Palantir, but with a different market size. And I think that these quality names like a Figma represents that same scarcity, because we actually have a shrinking number of stocks out there. There's a lot more privately held companies, but the public market's small. And then if you think about it, there's every year dividends are paid on the S&P. That's sitting on the sidelines. There's $7 trillion cash on the sidelines. People make income and they're saving 10%. If they don't buy stocks and they haven't been able to buy homes, this cash is piling up, and that's why it probably goes into the stock market.
Okay, so the knock valuation, the knock speculation. What about the knock of concentration? NVIDIA has the biggest weight in the S&P 500 of any individual stock since 1981, since data was being collected. The largest 10% of U.S. stocks now account for 76% of total U.S. market cap. That's the highest concentration in history. The top 10 names in the S&P account for 40% of the index. That give you any pulse?
I think when people cite these numbers, and I've also heard Max Myers say that like 2 stocks are bigger than like Tokyo's entire stock market.
Max is going to love the shout out, by the way.
Yeah.
Anyway, go ahead.
That we have to think about the earnings contribution. NVIDIA is producing incremental earnings at a incremental margin that tells you it's an incredibly scarce company. They're not making enough chips, and they are the center of the AI revolution. So I'm not surprised it's the biggest stock. I think from an earnings growth contribution, it's so big that those previous measurements aren't accurate.
Okay. Last one.
So again, he's saying you can't even go back in history and find examples in history. So then that's why you have to re-rate. You got a company like NVIDIA, which has still got 70, 75, whatever their percent margins. They're growing like crazy. There doesn't seem to be any limit to their growth, and yet their PE is still really low, given the amount of their earnings and the amount of their growth. Now, I believe, and I've said on the channel before, that I think NVIDIA's PE is low because people don't believe it. It's unthinkable that they could be a $6 trillion company as opposed to a $4 trillion company in terms of market cap, because they're so huge. They're the biggest company in the world now. But the truth is the earnings keep coming in and the order book keeps filling up. So at some point you have to cry uncle and say, okay, it deserves the valuation. And that you can go right down the line with that.
Consumer, not as great as everybody says. Brian Moynihan, Bank of America, comes on the network this week, has great things to say. I always say, don't listen to what people say. They're going to do, listen to what they actually do. And what they're doing is still spending money. Hugh Johnson, Disney, says, I know there's a lot of concern about the consumer. Well, we don't see it. Our consumer's doing very well. Under Armour, Crocs, Ralph Lauren, Pinterest, restaurant brands, Sweet Green, Wendy's, Chipotle, Jack in the Box, Yum Brands. I could go on and on even further than that, which might tell a little bit of a different story. So how do I square that?
Well, I think there's consumer preferences could be shifting, because you remember post-COVID, there was this boom in eating out and dining experiences. And we shouldn't say that that's a permanent change. And that's why you're seeing some of these. I don't think consumers are over levered. To me, that's the sign of a peak in consumers, because they can't amplify their spend.
So here's where I'm going to disagree a little bit with Tom Lee. I mean, I get what he's saying about the post-COVID rush to go out to dinner and to travel and go do the things you couldn't do during the COVID years. That was clearly there. I don't know if that is pulling back as much as maybe consumers are really going, hey, I'm not going to spend that kind of money to go out to dinner. It's not worth it. The restaurants have just gone crazy in terms of what they're charging. And maybe it's justified in terms of their input costs. I don't know. But the truth is, I think people are getting a little bit like, no, not going to do that. One suggestion I would have is you could cut back on the amounts. If the food is costing you that much, maybe pull back on the amounts a little bit. We don't need quite that much food on the plate. In any case, we're hearing about a little bit of a pullback in Vegas. Maybe that is just a year-over-year comparison. There's some evidence of that. But overall, I think the consumer is probably okay, and they're putting money in the savings account. So I don't think that there's a long-term problem.
Spending. That's what the banks are going to tell you. And if you look at the Fed's debt service ratio, we're still below COVID levels. So
people keep saying delinquencies are going up, consumers stretched.
I think that, of course, at any moment there is, but really in aggregate, you can't get a levered consumer until you have a housing boom. So consumers might be on short-term credit, some of these being stressed, but that's very different than us actually peaking really from long-term credit borrowing in a binge.
So that's why you say we're going to hit 6,600 by year end on the S&P, or it's almost 64 now. That's not like a tremendous move from here.
Yeah, I mean, I think our year end target is probably low, because I think we could do 6,600 this month. I think this is the month. Yeah, I think we're going to have a breakaway move in the S&P this month.
Even in what is a historic.
So Tom Lee, who has been at maybe the high end of the year's projection, we're almost to his year-end projection, which I have talked about on the channel a couple of times before. And he's saying, hey, we might hit 6,600 this month. So we're going higher by the end of the year. Could we end up having 3 years in a row of over 20%? And that would definitely, require a re-rating, because the earnings are not going to be, I don't think the earnings are going to be able to keep up with that. Now, maybe I'm wrong, and maybe in the fourth quarter, we'll start to see tremendous earnings because of productivity, the thing we've been talking about all along. Maybe even if sales can't quite keep going at the rate that they are, and sales are not down, but just not as strong, maybe productivity makes up for it, because at some point that is going to happen. The question is just which day.
Please, not the best seasonal period for stocks. We know August is usually like a nothing burger, and then September is usually a reversal.
That's
negative.
Right. I think that's everyone's playbook, that August should be weak and September down. But precisely for that reason, with the economy being stronger than people realize, Bitcoin made a breakaway move on July 9th. It has led the S&P for the last 5 years by almost 1 month. So I think it might start upside moving. S&P is coming.
All right.
Yeah.
That's your call?
I would say that's our base case, yes.
Starts next week.
I mean, I can't give you the hour and the
you
day.
Said it might start next week.
But that's 5 days.
Put yourself out there by all means.
Yeah, but I think it starts within the next week, yes.
Okay. Stay with us. We'll expand the conversation. Let's bring in CNBC contributor Courtney Garcia of Payne Capital Management and Obermeyer Wealth Partners, Allie Flynn Phillips. It's great to have you both with us. Court, you sat here, you heard everything that we talked about. He went right down the checklist. Valuation, that's not a problem. Too much speculation, not really. Too much concentration's justified. Is a consumer bad? No. Consumers find seasonals. He's a contrarian. He said we could have this rally starting next week. What do you say?
Yeah, I do think that we are well positioned here for a good second half of the year. I mean, we just continue to get good data on the economy. There is some questions with the labor market, and so I think we want to continue to see how that comes out. But I think at this point, we're just not seeing the consumer fall off a cliff, to your point. Like, yes, credit card balances are going up, but we're nowhere near like the peak levels we were before before COVID. So I really don't see this issue where we're going to go into some sort of a recession. And I also think if the Fed starts to lower interest rates, which is widely expected they will in September, those money market funds are going to be paying less and less. So that's one rate cut. But especially if we see multiple rate cuts, you're going to start to see some of that money coming back out and making its way back into the markets, which has not been happening over the last year. But at some point, you're going to start to see that as well. And that's something that I don't think is priced in at this point in time.
Allie, what's your take here?
So she's just basically agreeing, certainly with the consumer part of it. Jobs market, she says, maybe a little bit shaky, and that's possible. And the jobs market, to the extent that it's shaky, here's my current thinking on the jobs market. You basically have the productivity thing popping in there. You had companies that held on to their labor after COVID. You've heard me say this over and over and over again, that companies were not shedding labor the way they normally would because they saw the labor market as tight. So they held on to these people. They're still holding on to them. They're not laying anybody off. The layoffs are still, very, very minor. But what you don't have is you don't have more hiring because you don't need them, because you've become more productive. And this is what we're seeing. By the way, the numbers on college grads, though, which was a high thing and which was being talked about as a problem. Just a new stat the other day, college graduates are down into the 4.4 range, which is, about where the rest of the market is, college educated usually are below that, but it's still a lot better than it was even a couple of weeks ago. So apparently the college students are finding jobs. All right, let's go on.
I don't know. I think the best way to describe this environment is like a tug of war between the economic drag of tariffs and then the U.S. corporate earnings strength. The latter is winning so far, but getting granular is key to see in terms of which companies and consumers are going to eat these tariff costs. If you look at the earnings season so far, is largely fueled by artificial intelligence and financials. Around 80% of the companies exceeded expectations, which led to, in terms of revenue margin growth, surprisingly resilient and increase in terms of estimates for 25-26. But there's this huge bifurcation. As we talked about earlier, the Magnificent Seven stocks, average earnings about 26% versus the rest of the market 5%. We should see that convergence, but this sort of imbalance of power to us is in terms of disturbing long term. As much as I love the bullish sentiment today, we wouldn't be surprised if you see a little bit of this tension between in terms of the earnings and this sort of tariff framework. I mean, tariffs likely are set up about 19%, which we do think is an economic drag. But for us, we wouldn't be surprised if we see a pullback. But in that case, we think you have to be poised to take advantage of some good opportunities.
So he's going to say his statement is, okay, you got to buy the dip. So she's talking about pullback. She's talking about what I've been talking about, that maybe we're a little stretched. Maybe we need a breather. Maybe we need a 5%, maybe even a 10% pullback, but that would just be a great buying opportunity because the market is going higher. There's no reason right now for the markets not to go higher. Now, I would argue one thing they're never going to bring up on this is the housing could be that problem. Because you can't have this housing market stay this bad for this long. You can have it this long, but you can't have this housing market stay bad for a super long time before it starts to impact things, because between housing and the things you buy after you buy a house, not being slow, that is a drag on the market. I'm not as worried about tariffs right now as I am about housing.
Yep, Tom, is like even those who suggest you could be in for a period of bumpiness, maybe some turbulence, maybe some kind of a pullback, the suggestions have been that they would be bought pretty quickly.
Yeah, I mean, really since 2020, the dips have been shallow unless we have structural problems. I would say it's a good sign that investors are cautious, which is what we're finding. And as Laura was mentioning, there's tariff concerns. People just want to get through and see what tariff impacts there are but we also know that consumer expectations around inflation are cooling. I mean, it's prevalent in the 𝐄𝐦𝐚𝐲 surveys, the Consumer Conference Board, and also the New York Fed. So I think the Fed correctly is being patient, but that's a catalyst, because if we think there's cuts in the fall, that's good for stocks.
I did also see today, it was Bank of America's flow show, which showed a fair amount of money moving to cash. And maybe there's some anticipation of a pullback. Maybe not a full-blown correction, but a pullback that wouldn't feel that great.
Yeah, and I think pullbacks are normal, obviously, especially after this kind of run up that we've had since April. So I do hope that this turnaround happens next week, which you're calling for. I would love that. But I do think if there is a pullback, it absolutely is going to be a buying opportunity. But the question is where you're buying into, because yeah, there's this huge concentration we talk about right now, those 10 stocks, about 40% of the markets right now. And that's where something, I don't know if that trade is over. I'm not saying get out of those stocks, but a lot of clients have looked at their portfolios and they have no idea how concentrated they are. They have all these different mutual funds, a bunch of stocks they own. If you look at them in aggregate, you own so much exposure to these 10 companies. And that's what I want to caution investors, say, own those, but make sure you're not owning so much of it that if those things start to pull back, or you do start to see international continue to outperform, if there's this rotation to small caps, whatever it is, you want to make sure that you're diversifying your money, especially on any pullbacks that we see.
Alex?
So you've got this concentration again, this concentration issue coming up. But I like the discussion about the possible pullback. But however, what Tom Lee is saying, hey, we could see the stock market going up next week, going up to 6,600. Maybe that's where the pullback happens, because nobody's made that argument yet. But we get to 6,600, then we get the correction, and then we keep going maybe to 6,800 by the end of the year, something like that. I don't think, Tom hasn't changed his number for the end of the year yet, which is kind of interesting. But from everything I'm hearing here, and again, let's take into consideration that there's always, oh, well, if everybody's a bull, then it's a good time to be a bear. In this particular environment right now, it's, other than housing, it's hard to find a problem, something to be concerned about.
Where do you come down on that? There's a reason why they're concentrated. The earnings season pretty much just told you why the money continues to go there. Do I just want to stay there and play whatever offense I think I can get still? And look, the defense that these stocks have provided investors is a draw as well.
Well, the nice thing about it is there's other opportunities out there. And we've had a lot of talk about NVIDIA, which we like as a great company, but why don't we pair it with something like Taiwan Semiconductor? Complex high performance computing chips is a growing industry where TSM has about a 9% market share and growing. It just beat expectations across the board, but it's trading at 22 times earnings, not 30 times earnings. Eventually, it actually should really trade at a premium to the S&P given its moat. But right now, to us, something like that looks like a deal. Moving into a different sector, animal health, Zoetis, a resilient and growing industry. Animal health is probably GDP plus. As we know, many people will forego their own health expenses for pet expenses. Long term, we see this humanization of pets. And because everyone's been so focused on Mag 7, you've seen in terms of real earnings compression in a company like this. To us, that's a great entry point.
And this would be the point at which I would say Tesla. So Tesla has obviously not kept up with the rest of the run here. There's a pretty huge reason for that. There was this expectation of Tesla being, the president's favorite, and that we favored company status as a result of that. And of course, all that fell apart. So that run up was maybe artificial, but maybe we shouldn't be at 488 right now, but we probably should be at least at 400. And then as we do have the breakthroughs in terms of the robotaxis in Austin, et cetera, this is she mentions Taiwan Semiconductor. Well, even though Tesla's at massive multiples, there's a reason for it, and it is fallen behind. So I could easily see, if people are looking for someplace to put their money, Tesla could be an opportunity in this situation.
And also remember is we can look up, we can look overseas. Something like in terms of some of the data centers to us would be attractive as well.
Tom, what about a big, beautiful broadening this market? Does that come?
I think we're primed for that, because the equal weighted S&P PE is 16.9 right now. It was almost 18 on the eve of COVID. So the market has gotten cheaper after facing all these stress, even at an all-time high. So this
is the equal weighted argument that he made a couple of weeks ago, is that you have between 16, a little over 16 to a little over 18, that you could move without getting higher than the pre-COVID numbers.
case for stocks having better earnings performance there? Yes, if the Fed starts cutting and we're onshoring and the ISM's been below 50 for almost 30 months now, we haven't really seen a peak of the cycle until ISM breaks above 50 for a sustained period. That's earnings broadening. Yeah, and that's great. That would be great for industrials, financials, and as I quietly say, small caps.
I knew you were going to go there, which I've had a pretty good week on rate cut expectations. Yes. But the reason why the equal weight has gotten cheaper, it's the cheapest since COVID, is because AI happened since COVID. So it's inflated the PEs of the top heavy stocks and made all the others appear even cheaper because so much money has been going to the large cap tech names.
True.
But so it's skewed a little bit simply because of the AI trade.
That's true. But then we should think of it in sort of second order effects. The first is that the earnings growth of the median stock has actually been very good. So, and we saw it in earnings season because 83% are beating. And now the stacked earnings 2Q versus 2Q is over 12%.
Now those numbers are just huge. And this is what I've been talking about for the last couple of weeks, is for all the talk, for all the confusion, for all the sadness and about tariffs and everything else, what we have is an incredibly good earnings quarter. They'll talk in a minute about about what people are looking in terms of go forward. They're being a little bit cautious because they're not sure how tariffs are going to impact, but Tom will explain that as well. What happened?
Have you heard? Some people said that President Trump said that Bitcoin.
That's not just the Mag 7. But the second is that we know that the AI is progressing at a pace that it's delivering real benefits to companies. So companies are now going to see the benefits. I can't point to what it will be, but it's probably margins. And so that's a story that should be broadening earnings performance.
Well, depending on the impact of tariffs.
Correct. And tariffs are things that are well telegraphed and socialized. And as soon as markets view it as one time, we will actually look through those.
Yeah, but not maybe from a price increase standpoint, but not necessarily a margin hit, as you're already hearing from some of the retailers. They're just trying to get their arms around exactly what all this is going to mean for their margins and their prices.
That's right. So Scott, let's keep in mind, tariffs are going to create winners and losers because the companies imports are 10% of our economy. And the companies that are highly reliant on imports are going to have effects that they have to reprice their business and margins. But if someone said that should take down S&P earnings and the S&P 500, they're overlooking that the S&P is a broad set of companies.
Earnings going to hold up?
So Tom uses a number, which I'm going to have to double check him on this because my number is 14% of the economy. Not that that's a huge difference. Well, it's a huge difference, but I want to find out where he's getting his 10% number. I think that's a low number, but even at 14%, everything he said was right. It would be a higher impact.
I mean, so far they have been, and I do think we're probably well positioned here. And let's not forget, we're looking at this concentration that's been happening in the markets. But when you look out about 12 months out, 12 months from now, in the past, I'm trying to say, but you're saying things like financials, industrials, consumer discretionary, those are all up over 25%. So yes, tech is doing well, but you have actually been seeing money go into other areas. And I do think at some point here, you are going to continue to see that. Again, especially interest rates coming down are going to be a big key of this, which is likely happening in the fall.
I mean, the earnings picture that Tom paints is right. Our markets desk passed a note out today referring to the results as stunning. Earnings performance up 13.2% versus the.
So 13.2%. That's just incredible. As he said, stunning. And this is what I've been talking about for a couple of weeks, is as the numbers were coming in, we're going, this is very big. This is a big story.
Year ago quarter, almost 9% above earnings expectations. So there is data to support this picture. The question is, does it maintain itself?
And you're seeing that in guidance where companies have had really strong earnings, but they are being a little cautious moving forward, saying we don't really know how tariffs are going to impact us. We don't know how tariffs are going to impact the consumer. And I think that's where you are starting to see people aren't sure exactly how it's going to come out in the next couple of months, in the next couple of quarters here. But I am hopeful that we are going to continue to see these earnings coming in stronger than expectations. I think the bar is likely lowered because of the tariffs. And especially if you start to see all this come in towards the end of the year, I think it's just really setting up for a strong second half and a strong next couple quarters.
All right, we're going to leave it there. Courtney, thank you. Ali, thank you. And of course, Tom Lee, thank you.
All right, so there you have it. Absolutely, again, stunning set of analysis. Nothing that has certainly not in people's expectations. Really a solid quarter in terms of earnings, and people with money on the sideline trying to figure out what to do with it because they feel like they're underinvested. Is that you? Let me know in the comments below. You feel like you're underinvested compared to where you need to be? Are you thinking that, are you putting money into savings instead of putting it into Tesla or into other stocks? I'd love to hear that in the comments as well. So anyway, this is, I know, very different for me to use a program like this as the backdrop, but it was, to me, unbelievably on point in every way, shape, and form. So that's why I wanted to bring it to you. Let me know also in the comments if that was okay with you, if you felt that was a good way to provide you with information that you might not have seen otherwise. All right, that's all I got for you right now. Do hit the like button if you didn't already, subscribe, notify, and it's been great, as always, talking to you.